Okay, now see here, in charitable trust, what is our status? We have done the meaning, conditions and registration. Even computation, most of the points we have done. Actually in computation there were how many points? There were 14 points, and out of those 14 points we have done 13 points. Now see, what is the last point remaining? Exit tax. This point is remaining. Look, exit tax is remaining, but my plan is what? Based on this much knowledge, we will take one question right now to understand how to solve this sum. Okay, but before even starting this sum, I want to discuss this point. Look, section 11.5. You know what is section 11.5? It prescribes the investments where trust should keep its money, because a trust cannot keep its money anywhere. It has to keep it invested in these securities only. And the logic of prescribing a security is what? Basically law wants the money should remain safe in good places, where money should remain safe basically. Like see, G stands for government securities. If trust has kept all its money in government securities, that means the money will remain safe. See, all this investment which I am going to say, they are all safe investments, and trust is not allowed to invest anywhere else except these places. So see, you can remember this with a keyword GPD bio. What is this? GPD bio. In that, G stands for what? Government securities and government savings certificates. This is the first point, government securities and government savings certificates. Okay. Then P stands for public sector company. Investment in shares of public sector company or deposit with public sector company. Look at this. Investment in shares of public sector company or deposit with public sector company. Again, this is a safe investment, because public sector company means it's a company where government has got more than 50% stake. So when government has a stake in such company, that means even this is a safe investment. So this was GP. Then D stands for debentures of a normal company, where principal and interest is guaranteed by government. Means now we have to invest in some debentures, and debentures are of normal company, but these are such debentures where the principal and interest is guaranteed by government. And since it is guaranteed by government, again it becomes a safe investment. See, in every investment you will get the feeling of that these are safe investments. So what was D? Debentures of a company where the principal and interest is guaranteed by government. Then GPD. Next alphabet is again D. There are two D's. Another D is deposits. Deposit with bank, post office, cooperative bank. It can be any scheduled bank. Scheduled bank means most of the banks nowadays are all scheduled banks only. So deposit with any scheduled bank, cooperative bank, post office, savings bank. And deposit can be in savings account, fixed deposit account, any account. But you have to deposit with these banks only. Okay. In one exam they had given that trust has deposited in NBFC. NBFC is not allowed. Here it is only scheduled banks. Okay. Cooperative banks and post office savings bank it should be. So this was second D. So GPD is done. Then bio. In bio, next alphabet is what? B. B stands for bonds of specified financial corporation. Which are the specified financial corporation? These are the financial corporation which were discussed in PGBP. In PGBP section 36(1) was there. There we had one keyword C by FR. In C by FR, what was R? Transfer to special reserve. There are some specified financial corporation, when they transfer to special reserve, they get one deduction. If you remember, the formula was actual amount transferred to special reserve, 20% of the taxable business income, 200% of share capital plus general reserve minus opening balance in special reserve. There was some formula kind of thing. This deduction was allowed to, if you remember, financial corporation engaged in providing long-term finance for agriculture, industry, infrastructure development, and those providing long-term finance for residential houses. So such financial corporations bonds you have to invest in. See, I have written in short, but in the act, you know what they have written? Bonds of specified financial corporation as mentioned in section 36(1) of Income Tax Act. And 36(1) means C by FRR. In short, these are financial corporation who provide long-term finance for agriculture, industry, infrastructure and residential houses. So if you invest in bonds of such financial corporation, even that is a prescribed investments. You know what we are studying? Which investments are prescribed for charitable trust. Then this was B here. Next alphabet is I. I stands for immovable property. Investment in immovable property is also safe investments. Because whenever you invest in immovable property, your money will not be wasted. It will never be lost. It is always appreciating. Then last O stands for others as may be notified. Others as may be notified. So these investments name you have to remember, okay? See, if you remember in corpus donation theory, what did I say? Whenever you receive the corpus, you have to keep it invested in 11.5. So sometimes in the question they will give you that we received the corpus, but it is invested in some different place only, which is not fitting in GPD bio. So tell me, if the corpus is not properly invested, what will you do? In this statement, you will show at the bottom. And if corpus is not properly invested, it will be taxed at 30%. It comes in ADIA 115 BBI. In ADIA, I was corpus not invested properly. In short, I am just trying to show the importance of these investments. In exam, you should always check trust has invested their money in these investments only. Now see, there is one point over here in public sector company. Sometimes a public sector company ceases to remain a public sector company. You know why it happens? Because public sector company means it's a company where government has got more than 50% stake. But sometimes that more than 50% stake reduces. Means maybe government has sold its stake to some other party and now government shareholding in that company is not more than 50. It is just 30%. This is called disinvestment in public sector company. So if that happens, then you know what will happen? Public sector company, which was till now a public sector company, is no more a public sector company. But we have already purchased shares of such company. So in such case, you know what is written in the law? Even if that public sector company ceases to remain public sector company, your share investment will remain a valid investment only for 3 years. For 3 years, your share investment will remain valid. See, technically, my investment has become invalid investment because public sector company, which was a public sector company, is no more a public sector company now. And once that company is no more a public sector company, what will we say? Our shares are of non-public sector company. So technically it is not allowed, but see, it is not the fault of the trust. Na? When trust invested in that company, that time they were public sector company. Now suddenly if that public sector company becomes a non-public sector company, it is not the fault of the trust. But you know what law says? But you do one thing, within 3 years you transfer your shares. Means you are given time of 3 years. Till 3 years, even if those shares are still held, even if that company is not a public sector company, law will say it is a valid investment only. But till 3 years, 3 years counting is from date when public sector became non-public sector. It is exactly from the date. You know, this point was tested in one recent paper. In one recent paper, they had given a situation that there is a trust who has invested in shares of a public sector company. Now suddenly that public sector company has become a non-public sector company. So what to do? So answer is what? It's okay. Even if public sector company has become non-public sector company, for at least 3 years, our share investment will remain a valid investment. But you know that 3 years rule is for shares. But if you are deposited in a public sector company, like if you made a FD with public sector company, so it will always remain valid till the FD matures. Because FDs cannot be sold now. See, shares at least you can sell. So law says you sell the shares. Now the company is not a public sector company. You sell it within 3 years. For 3 years, we will not trouble you. But make sure that you sell your shares within 3 years, because that company is no more a public sector company. Means what I am trying to say, for shares, there is a possibility to sell, na? But if you have made some FD with public sector company, then FD cannot be sold. So until that FD matures, your FD will remain a valid investment, even though that public sector company is no more a public sector company. So this point was tested in recent paper. So in short, these are the list of investment prescribed under section 11.5. The keyword is GPD bio. Okay, now we will take one question, but before solving this sum, I will give you the format. See, I have done one thing. I have made an exhaustive format in which everything will fit. Trust me, every question you can fit in this exhaustive format. See, this format will run into 3 pages. This is page 1, this is second page, and this is third page. See, broadly the structure of the format is like this only. This same thing I have given in a detailed manner. See, if you notice, whenever you calculate trust's income, the calculation is in 3 stages. Tell me why 3 stages? Stage 1, you will write some incomes at the top. And second stage is minus. Can you see minus? This is the second stage where you will provide all exemptions. In which what will come? 15% exempt, applied, deemed to be applied, accumulated. That I am calling it as second stage. And then what is the third stage? There are certain income which you add at the bottom of the statement. If you remember in my previous lecture, for many incomes I said that you will write up or down. So in short, see, first I want you to by heart, whenever you prepare a statement of computation of trust income, your visualization should be the statement is in 3 parts: upper part, middle part, and bottom part. In upper part, you will write only those incomes which are eligible for exemptions. Only those incomes which are eligible for exemption, you will write at the top. And then after you add all the incomes which are eligible for exemption, start subtracting. What you will subtract? 15% exemption fixed. Then whatever is applied for charity, less. Then less not applied because not received. Then less not applied because of other reasons. Then accumulated. All this you will deduct. And then deducting thing is the second stage. And then at the end, when you get the final answer, you will come to the third stage where you will add all those income which are not eligible for exemptions. So in short, by heart this thing that our statement is divided into 3 stages. And see, same thing I have shown here. Look, this is first part of the statement where I have written all those incomes which are eligible for exemption. And then after writing those incomes, the second stage is minus. In that minus what comes? This will come. And see, these are all minus things. And then what is the third stage? Add all those incomes which are not eligible for exemptions. You know why you write these incomes at the end? Because if you write these incomes at the top, 15% exemption will be allowed, which we don't want. Now see in detail. So tell me, in the upper part of the statement, we will write which incomes, those which are eligible for exemption. So which incomes will come there? Look, in the question they might give income from property held under trust. You know this is which income? Look, income from property held under trust means every trust is created by an author. And when author gives the property to trustee, that base property is the main property which creates the trust. And this property will generate income. That is the main income of the trust. It is called income from property held under trust. If you remember in this explanation, I told you that author had given some property to the trustee. So this property will generate income. So that is called income from property held under trust. Then what other incomes a trust can have? Trust can carry on business. Okay. But what is the rule for business? Only if the business is incidental to the achievement of the objects of the trust. and separate set of books are maintained, then only the income will come at the top. Otherwise, if the business is useless business, it is not connected with the objects of the trust, or even if incidental, you have not maintained separate set of books, then it will not come at the top. Then where it will come? At the bottom of the statement. And you want to see the bottom of the statement, see here. Non-incidental business income will be added at the bottom of the statement. Okay. And if you remember, what was the meaning of incidental business? I gave you one example, like there is a religious trust running a temple, and outside the temple there are some shops where they are selling idols of God, they are selling flowers, offerings which people do for God. So anything related to spreading of religion, so that will be incidental business. So incidental business income will only come at the top, non-incidental income will come at the end. Then, see, we are trying to write all possible incomes of a trust. So first income was income from property held in a trust, then income from incidental business, then donations also form the major part of trust income. Now tell me, what are the different types of donation we have studied? Corpus donation, anonymous donation, and normal donations. So tell me, what is the treatment of corpus donation? See, this statement is kind of a recap of what I have taught till now. So tell me, if in the question they give corpus donation, what you will do? You will put amount or dash. You will put dash. Because as I explained in the last lecture, corpus donation we treat it like a liability. It is kept in balance sheet liability side. It is not an income. Okay. But you will put dash provided it is invested under section 11.5. And which investments are prescribed under 11.5? I explained today. GPD bio. Then anonymous donation, up to certain limit it will come at the top. Tell me, this up to certain limit means what? 5% of the total donations, or 1 lakh, whichever is higher, that much you will write at the top. What about excess anonymous donation? That will not come at the top, it will come at the bottom. See, bottom means I have written here, look. Excess anonymous donation. See, trust me, this format is a good format. It will cover everything. Then all other donations, what is the rule? Just write the amount as it is. No special treatment for normal donation. See, corpus donation has special treatment that you have to put dash. Anonymous also has a special treatment, little bit up, little bit down. But all other donation you have to give a normal treatment. Whatever amount is given in the question, just write it in the statement. And then, if trust has got agriculture income, if you remember last lecture, what did I say? If trust has got some income which is exempt under section 10, even 10 incomes are treated as normal. But if it has got agriculture income, then it will be exempt straightforward. What about other 10s? Other 10s you have to write here as an amount. And then if applied for charity, exempt. Otherwise, exemption will not be allowed free of cost. For other 10 incomes, what does the law say? You will get exemption, but only if you do use that income for charity. But for agriculture income, whether you use that income for charity or you don't use for charity, it is a straightforward exemption. That's why, see what I have written, I have put a dash only. And then all other incomes, you will write the amount like a normal income. Okay. So see, basically, you know what I did? Here at the top, I wrote all the possible incomes which can appear in a question. Then after you add all the income, you will get the total, and from the total 15% you will deduct. And then tell me, then what will come? After you deduct 15%, what comes next? Less applied. Okay. So now the next section is of applied. Now in applied, what rules you have to follow? What are the rules for application? Firstly, applied means it should be actually paid. If some expenditure is outstanding on accrual basis, you cannot claim applied. Because basically applied will include expenditures, but expenditure should not be outstanding, it should be paid. Then next point is income should be applied, Income applied is called applied. I stressed in last lecture, applied means income applied. If you apply loan, if you apply corpus, then it is not income applied. Because when you apply the loans, when you apply the corpus, your balance sheet is getting empty. But for us, applied means income applied. See, my stress is on income applied, you have to subtract. But loan applied, corpus applied, see, I put cross. Cross means these things you cannot minus. I told you in last lecture, when you take the loan and when you use the loan, using the loan is not applied, although you are using the loan for charity, but it is not income applied, na? So that you cannot minus. See, this is actually recap of what I already taught you. Then in applied we can write revenue expenditure, we can take capital expenditure, and loan repayment is also applied, provided loan is repaid within 5 years from the end of the year when loan was used. And reinvesting in corpus. If you remember last lecture, I told you Ambani gave us 10 lakhs to keep it in FD, but due to some reason we had to break the FD because in our old age home all the old people got COVID, remember? But after using the FD, we felt like rebuilding the FD. So rebuilding is also applied, but it should be rebuilt within 5 years. Then giving donation to another trust is also applied. See, basically in applied, whatever can come, I have written all possibilities. But see, when you donate to other trust, it is applied, but only 85% will be allowed to be subtracted. Then when you subtract anything in applied, you have to respect section 40A and 40A3. What does 40A say? If TDS is to be deducted, deduct. Otherwise only 70% can be subtracted in applied. And if there is a payment exceeding 10,000, don't do it in cash. If done in cash, you cannot subtract it. Then in applied, you have to apply the income for public. You cannot apply for ATS. Then this is all about applied. Then sometimes you have not applied the income because it is not received, but still it is deemed to be applied provided you submit form number 9A. Then sometimes you are not applied due to some other reason, like you received the income on the last day of the year, even that is deemed to be applied provided you submit form 9A. Then sometimes you accumulate the income for future purpose, even that you can minus provided you submit form 10. And till the time you use the money, keep it invested in 11.5 means GPD bio and file the return on time. So these were the 4 main subtractions which I had explained already in the last lecture. Okay, now after all this, what you will do? This is the income after all exemptions. Now you will add those incomes which are not eligible for exemption, like non-incidental business income you will add. And then sometimes for your past mistake, means for your past promises which you didn't fulfill now, some past promises which you didn't fulfill now, exemption has to be withdrawn. Like in past you said we will accumulate the income and use it for hospital etc., but you never constructed any hospital. So all those past exemption withdrawn will be shown here as add. Then if corpus see, generally corpus donation is not recorded in income. See what I did, I put dash, but that is if invested properly under 11.5. But if the corpus is not invested, then you will record it as an income at the end. Okay, and this will be subject to 30% tax also because it is in Area I. Excess anonymous donation will also come here. So this way you total up the income. So this format is an exhaustive format. Now you know what you will do. This final income you will split into 3 parts. In this income, whichever income is from Area, you will separate it because on that there is 30% tax. And in this, if excess anonymous donation is there, even that is subject to 30% tax. But the section for Area is 115 BBI and section for anonymous is 115 BBC. And then all balance income will be subject to slab rates. So this is the exhaustive format. Now we will use this knowledge for solving one question. See, there is one question. See question number 1 from your book. See, in this question, my objective is to explain the method of solving. Can you tell me what should be the method of solving the question? Because question is always created in a messy and a haphazard manner. But we have to organize it properly. And organize it properly means, if you remember right now, what did I say? In your answer, the statement will be divided into 3 sections. Certain incomes will come at the top, and in the center of the statement you will write all exemptions, and some incomes will come at the bottom. So see, accordingly I will do the markings. See here, like first income given in the question is what? Income from property held under trust and income from incidental business. So this is firstly income. So income, there are only 2 options, either right at the top or at the bottom. So tell me, this income is a normal income, it is eligible for exemption. So where you will write, at the bottom or at the top? At the top. So see what marking I have done. Look at this. I for income. And what does that arrow indicate? Arrow pointing upward means I will write this income at the top. Okay. You can also do this marking. Okay. See, any income which I want to write at the top, I will write I and arrow pointing upward. If I want to write some income at the bottom of the statement, I will put an arrow downwards. Then read the second income. See, basically what is asked in the question, look, let's read. Compute the total income and tax liability. See, in the question of trust, generally they will ask this only. Compute the total income and tax liability. Then read second point, voluntary contributions received from public. What do you mean by voluntary contributions? Donations. These are donations. But it includes corpus donation of 5 lakhs and anonymous donation of 10 lakhs. It includes means it is included inside 40 lakhs. So can you tell me the breakup of 40 lakhs? In 40, how much is corpus? 5 lakhs. How much is anonymous? 10 lakhs. And what about balance? Balance is your normal donations. So tell me the effect of all. I have already explained. Corpus donation you will put dash. Okay, so how much is corpus? Wait, how much is corpus? 5 lakhs. So you will pass the entry for corpus donation at the top of the statement, huh? But amount will be dash. And what about anonymous? Some portion will come at the top of the statement, remaining portion will come at the bottom of the statement. What about normal donations? Everything will come at the top. See, this donation treatment you buy it because every question donation will always come. So what to buy it? Corpus you will put dash, anonymous little bit at the top of the statement up to the limit, balance at the bottom. All other donation will be normal. So tell me, in our question, corpus you put dash. What about anonymous? How much you will write at the top of the statement? Calculate. 5% of total donation or 1 lakh, whichever is higher. To calculate 5% of total. What is the total donation? 40 lakhs. 5% of that comes to 2 lakhs. Compare with 1 lakh, whichever is higher. 2 lakhs. So 2 lakhs will come at the top of the statement. But total, how much is anonymous donation? Total anonymous is 10 lakhs, na? Of which you wrote 2 lakhs at the top. So balance 8 lakhs you will write at the bottom of the statement. And all other remaining donation you will write as usual full amount. Now tell me, for corpus donation, we have to make one assumption that it is invested under section 11.5, because many times the question will not specify, but if the problem is silent, make positive assumption, because generally whenever trust gets corpus, they do invest it. So nothing is given, so better to assume it is invested. By chance if they say it was not invested, then what you will do? Corpus uninvested comes at the bottom of the statement, and it is a candidate in Adiya. Adiya I. Adiya I is what? Not invested, not invested, okay. But that is if they specifically mention it is not invested in 11.5. But here problem is silent, so we assume it is invested. So see here what marking I have done. Tell me why did I write two arrows, up and down both? Because anonymous donation will come little bit up and little bit down. So in short, this point will have the effect at the top of the statement also, and something will come at the bottom of the statement also. That's why I have shown both the arrows, up and down both. Then read third point. 44 lakhs was applied. The moment you see applied, so tell me this will come at the top or at the bottom or at the middle. See, this is the middle section of the statement. See, we have got three segments. The middle segment is of less, 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 less. Okay. So see what is given. 44 lakhs was applied for charitable purpose, including 4 lakhs paid to contractor in cash. Cash payment is allowed or not allowed? Cash payment is not allowed. And that too the amount is 4 lakhs. Up to 10,000 is okay, but this is 4 lakhs cash not allowed. So not allowed means what you will do? When you deduct applied, you will not deduct 44 lakhs. You will have to subtract 4 lakhs. Why? Because it is already included inside that. Na? And then amount applied includes purchase of new computers and software 15 lakhs out of loan. You know what is the rule? Applied means income applied. Loan applied is not applied. So tell me, in this is included and this is also included. So what to do? Let it be included or remove it? Remove it. This you have to remove because it is cash payment, and this you have to remove because it is not income applied, it is loan applied. So tell me, after removing 4 lakhs and 15 lakhs, you are left with what? 44 minus 4 minus 15, 25 lakhs. And this you will show as applied. APP means it will be shown in applied. See, in your mind, one thing should repeatedly go on. My answer will be in 3 segments, top, middle and bottom. Okay. Read 6th point, sorry, 4th point. See, by mistake it is written 6, it is 4. Huh? Serial number is written by mistake 6, it is actually point number 4. Whatever. Trust gave donation of 12 lakhs to Balaji Trust, which is registered under 12AB. This includes 2 lakhs as corpus. Tell me, what is the rule of we donating to other trust? We can donate our income to other trust, but we will get deduction of full amount to 85%. 85%. But it should be given as a normal donation, not as a corpus. So see, here out of 12 lakhs, we have given 2 lakhs as corpus. So that you cannot subtract, because corpus, that other trust will not show in income, na? So that's why I am not allowed to subtract. So remove corpus. So how much is given as a normal donation? 10 lakhs. Out of that also only 85% I can minus. So see, this will also come in applied. See, donating to other trusts is also kind of applied for charity. Then try next point. Income of 2 lakhs could not be applied for charitable purpose as the same was received on last day of the previous year. So tell me, this thing you could not apply, and is it due to valid reason? It's a valid reason, because if you receive the income on the last day of the previous year, how do you expect that it will be spent in the same year? So here, this rule I will follow. Which rule? Income not applied due to other reasons. See, this was not received only. In this point, the income is actually received, but received on the last day. So this is called not applied due to other reason. And such incomes are called deemed to be applied. Even this you can minus, provided Form 9A is submitted. And regarding Form 9A, problem has not mentioned anything. So we have to assume that Form 9A was submitted. because they will not tell you about small details. Certain things you can assume. If the problem is silent, make positive assumption. So see here what I have written. Deemed application. This is called deemed application. See, when you subtract, there are 4 sections. Look, applied, 15%, applied, this is deemed to be applied, and then accumulated. So particularly this will come in deemed to be applied. Then read 6th point. Income of 5 lakhs was accumulated for future charitable purpose to be utilized within 4 years. The said amount is invested in 11.5. So tell me, this is income accumulated for future purpose. Now tell me, what are the conditions for income accumulation? Tell me, what are the conditions? You have to submit form 10. You have to invest under 11.5. Return should be filed on time. See, if the problem is silent, we can assume all the conditions are fulfilled. But here, let's see, they have given that it is invested in 11.5. This thing is given, but problem is silent about whether form 10 is submitted or not. But we can assume positively. See, make a rule. Whenever problem is silent, make positive assumption. And even the return is assumed to be filed on time. So in short, this also you can minus. So see here what I have written. This will be shown in accumulated. Then next point, income of 4 lakhs was accrued in 23-24, but it was received in 24-25, is not yet applied. Not yet means, what is our year? 25-26 has also gone. Not yet applied. You know, this is what in 23-24 some income was outstanding. So while filing the return of 23-24, you might have claimed exemption, saying what? That income is outstanding, how can we apply? So in that year you got the deduction, you got the exemption. But then what promise you have to make for outstanding income? Whenever it is received, either in that year or the year next following, you have to use it. This promise you have to make for all outstanding income. So in 23-24 we promised that we will use in the year of receipt or the next following year. So what is the year of receipt? 24-25. So we should have used in 24-25, but after that also you get 1 year grace. After 24-25, next is 25-26. So we should have used in 25-26. But what they are saying, it is not yet applied. So this is bad. So what exemption you claimed in 23-24 will be withdrawn. And where to show exemption withdrawn? At the top of the statement or bottom of the statement? Bottom of the statement. So see what I have written here. An arrow is down means you will show at the bottom. Here I have shown all exemptions withdrawn, you have to show at the bottom add. Then read this point, last point. Income of 6 lakh which was accumulated in 23-24 for construction of a school within 3 years is misused. Tell me, what is the rule? Accumulated income you have to use for the purpose for which you accumulated. Na? But here, what did they do? Did they use it for school or they misused it? Misused. So misusing accumulated income will also lead to past exemption withdrawn. Means what exemption you got in 23-24 will be withdrawn. And even this will be shown where? At the bottom of the statement, exemption withdrawn. So see here what code I have written. I arrow down. See, now the answer is simple. Now let's check the answer. What will be the title? Computation of total income. So see, first I will write those income which are to be written at the top. And then minus things will come. And then you will write those income which will come at the bottom. So see one by one, which incomes are there to be written at the top. Count and tell me. Count the number of items. 80 lakhs, 10 lakhs, and then in donations also there were 3 donations. 3 means corpus, anonymous, little bit you will write at the top now, and other donations. Okay, that's it. Nothing else is there to be written at the top. See, these incomes will come at the bottom. So at the top only these 2 things will come. And here also there will be total 5 entries. You know why 5? 80 lakhs, 10 lakhs, 2 things. And then in donation also we had 3 varieties. So see, I'll show you the 5 entries one by one. First is that income from property held under trust. Then next was what? What is this 10 lakhs called? Income from incidental business. Check that. Okay, and then next is all donations. Donation you will classify into 3 parts. Normal, corpus, anonymous. Normal was how much? From 40, if you remove corpus and anonymous, normal was 25 lakhs. Corpus you will write dash, nil. And anonymous you will write only up to the limit. And what was the limit we calculated? 5% and 1 lakh, whichever is higher, that came to 2 lakhs. So that much you will write here. So in all 1, 2, 3, 4, 5 entries came out of point number 1 and 2. Okay. So all the incomes to be written at the top are done. Now comes the middle segment of the statement. What is the middle segment? Less 15%, less applied, less deemed to be applied, less accumulated, and then final answer. And then at the end, the bottom part. So see, first you have to total this. Why total? Because now I want to calculate 15%. No? So less 15% exempt. So after subtracting 15%, this is the balance 85%. Now what will come? Go as per format. Format is fixed. Now less applied. In applied, what we have? Tell me. See, I already denoted applied. This is there in applied, this is there in applied. Exactly tell me the amount. In applied, we have not full 44 lakhs. From 44, you have to subtract 4 and 5. So how much is applied? 25 lakhs. Actually, in the question, they had given 44, but of which 4 lakhs was applied in cash, which is not allowed, and 15 lakhs was not income applied, it was loan applied. Then what else was there in applied? Donation to another trust. And there out of 12 lakhs, 2 lakhs was given as corpus, so ignore it. Only 10 lakhs will be counted, that to only 85%. That comes to 8,50,000. Then what else is there in applied? Only these 2 points were there in applied. Then comes deemed to be applied. That was how much? 2 lakhs. Deemed to be applied, 2 lakhs. See, I have written here. Not applied because received on the last day. Then after that what comes? Accumulated. How much is accumulated amount? 5 lakhs. So subtract accumulated. So this becomes the middle segment of the statement. Okay. And then what is the answer at this stage? This much. Now you will write all those income which we decided to write at the bottom. So tell me which incomes will come at the bottom of the statement? This and little bit of anonymous also. See, for anonymous, excess anonymous will come at the bottom of the statement. Huh? So that is one thing, and this is another, and this is one more. So check one by one. See, these 2 amounts are 4 lakhs and 6 lakhs is what? Same thing which was there at the end of the sum. What was the amount? 4 lakhs and 6 lakhs. 4 lakhs and 6 lakhs. So match the amount, 4 lakhs and 6 lakhs. Then what about excess anonymous? Total anonymous was 10 lakhs, of which at the top we have already written 2 lakhs. So what will come at the bottom? 8 lakhs. That's it. In short, see, I have given you a super master format. In that format, everything will fit. And then this is the final taxable income. Now, this you have to split into three parts. Tell me what are the three parts? ODI income, excess anonymous, and balance income. So, check in our question, do we have ODI income? Check one by one. In ODI, what was A? First A was not accumulated systematically, or in past you accumulated systematically but currently you broke the promise of accumulation. So do we have any accumulation promise broken? We have. See, you should read this sum properly. Na? See, this accumulation promise which we did in 23-24 is broken this year. So this is Adias A. Then in Adia, what was D? Deemed application promise broken. Even that was there. See, in 23-24 there was something outstanding. So that was deemed to be applied that time. But that promise also we broke. So in Adia we have A. In Adia we have D. Then in Adia what was I? If some income is uninvested, like corpus is to be invested, but if uninvested it will come. But that was not there in our question. Then in Adia what was last A? Income used for the benefit of ATS. That was not there. In this question, income used for benefit of ATS was not there. So in Adia, which items we have? A, accumulation promise broken, and deemed application promise broken. So add and tell me what is the amount? 10 lakhs. So see how I have split. This is Adia income which is 10 lakhs. Then tell me how to make the split. Adia, excess anonymous and balance. Now what is the excess anonymous donation? Excess anonymous, excess means after subtracting that 5% or 1 lakh whichever is higher. So excess amount is 8 lakhs which we wrote at the bottom of the statement. See, excess anonymous donation. Then what was the total income? 76 lakhs 95,000. From that you subtract this and this. So this will be the balancing figure. So what is the balancing figure? 58 lakhs 95,000. And then tax on above, on this 30%, on this 30%, on this slab rates. Okay. So calculate 30%, 3 lakhs. Calculate 30%, 2 lakh 40. And on this apply slab rates. What is the shortcut for slab rate? Directly multiply by 30% and minus 187 500. You forgot the shortcut in slab rates? Directly multiply by 30% minus 187 500. This shortcut I gave long back. So this is according to slab rates. And then add all the amounts. Then surcharge will also come. See, trust is taxed like individual people only. And what is the surcharge for individual? If income exceeds 50 lakhs, surcharge will be 10%. If it exceeds 1 crore, 15%. If it exceeds 2 crores, 25%. If it exceeds 5 crores, 37%. But here it is just exceeding 50 lakhs. So 10% surcharge will come. Look. So my tax was 21. On that surcharge will be 2,12,100. Then add health and education cess, and this is the final tax payable. So this way you have to solve the question. Okay. So see, one question I have helped you how to solve. Now in homework I will give you 2 questions of similar lines. And out of those 2 questions, one is a master problem. Okay, one is a master problem. Especially see this question. Question number this. Question 3 is a master problem. So question 2 and 3 I will give it in homework. Okay. There are only 4 questions we are having. One we did. 4th I will do today only. 2 and 3 will be in homework. Okay. Because question 2 and 3 is on the same lines as I have discussed right now. Only thing is question 2 and 3 will cover as many points as possible. Because see, you know what I have done in my book? In my book I have kept limited number of sums but maximum points to be covered in less number of sums. So if you count, you will feel there are only 4 questions in our book. But see, this question, question number 3, it is covering so many points. It's a master problem. Means what satisfaction you will get by solving 10 questions, that satisfaction you get by solving only one question. This is the idea, is to save your time. So question 2 and 3 you can do it in homework. Now let me take the chapter further. See, what is the status of our topic? We have to yet do this 14th point, exit tax. And cancellation theory is also remaining. Cancellation of registration of trust. So I'll do one thing. First I will do the theory of cancellation. Because exit tax theory is connected with cancellation theory. So it is better first I teach you about cancellation of registration, then exit tax. So see, look here. See this. See, in one lecture I told you how a trust should get the registration. I had explained sometimes you can take provisional and then you can convert into regular. But if you want direct final registration, you can take final also directly. Now, that was a procedure of seeking the registration. But sometimes your registration can get cancelled. And registration getting cancelled means it's a bad thing. Means henceforth the trust will not get the exemption. Tell me, what is the section for exemption for a trust? Section 12, 11 and 12 provides exemption of income to a charitable trust. But only if they are registered, na? But if your registration gets cancelled, so you won't get exemptions anymore. But the point is, when they will cancel the registration, firstly, who will cancel? CIT. Because it was CIT only who gave me the registration. So cancellation authority is with CIT. But the point is when they can cancel. So see, there is a keyword here. GC or BUL. How to read this? GC or BUL. In that, G stands for if the activities of the trust are not genuine. You know, this CIT, he keeps an eye on every trust. CIT will keep an eye on every trust, and if someday he feels the activities of the trust are not genuine, he will cancel the registration. But see, he will not directly cancel. There is a procedure to be followed. That procedure I will show you below after some time. Right now you understand the circumstances when cancellation can happen. So G stands for what? If CIT notices that the activities of the trust are not genuine. Then C stands for if the activities of trust are not in accordance with the conditions for registration. You know, when CIT grants you registration, he puts certain conditions that only if you fulfill this condition, your registration will remain valid. But later on he noticed that your activities are not matching with the conditions which were imposed while granting registration, so you will cancel it. See, both these points start with the word activities. Activities, activities. But here you will say activities not genuine. Here you will say activities not matching the conditions for registration. C for what? Conditions for registration. Your activities are not in accordance with conditions for registration. And both these sentences will start with the word activities. Try to by heart the sentence. Huh? O stands for income of the trust is not used for the objects of the trust. Like see, if a trust has got the object to spread education, but CIT realized that whatever income you are earning, you are not using for your objects. Then for what you are doing charity? See, all this only if CIT comes to know, he will take the action of cancellation. Huh? So what was O? Objects of the trust. Exact sentence is income of the trust is not used for the O for objects of the trust. R for income of a charitable trust is used for a particular religious community. R for religious community. Like see, there is a charitable trust and it is working only for Hindus or only for Jains, only for Sikhs, only for Muslims. So this is discrimination. See, if it is a religious trust, obviously a religious trust, if they are running temples, so they will promote Hindu religion only. If it is running a church, it will promote Catholic religion. So religious trust can do. But if a charitable trust, they are focusing on a particular community, that is wrong. Like see, for example, there is one old age home. And in that old age home, only Muslims are taken care of. So that is bad, no? See, if it is a mosque, if it is a masjid, then it is for promoting the religion of Muslim. That is okay. So see, this R is what you know. If a charitable trust dedicates the income for a religious community, particular religious community, that means if a religious trust does that, that is normal. Then cancellation will not happen. If you see in my book, I have written, if a charitable trust, charity doing trust, if they are focusing on a particular religious community, that is bad. Your registration will get cancelled. So R was particular religious community. Then B stands for if trust carries on a business which is not incidental to the achievement of the objects of the trust. Like if you remember, I said there is a trust running a temple, religious trust, and outside the temple there is a shop where they are selling watches, mobile phones. Sale of watches and mobile phone has got no connection with spreading of religion. Na? So if you do such business, then what will happen? Your registration is subject to cancellation. But see, you will say, but sir, you said na, that even if the business is not incidental, you have to write in the statement, but at the bottom of the statement, see, till your registration is not cancelled, you have to report that income. Na? See, even if I am carrying on some business which is not incidental, so I am earning the income, na? So that income I have to show in my returns. But CIT can take that reason also for cancellation. But cancellation will happen only if he takes the action. Na? Tell me, until he takes the action, how will I report that income? Which income? Income from business which is not incidental. That income I have to show in my filing of return. And where will I show in my filing of return? Where will I show in my filing of return? At the bottom of the statement. Okay. But you should be mentally prepared that since you are having income from a business which is not incidental, anytime CIT can take action of cancellation of registration. Okay. B for what? Business run by a trust which is not incidental. Even if incidental, you are not maintaining separate books. This point also I said that sometimes your business is incidental, but you don't maintain separate books. So in filing of return, you will show at the bottom of the statement. But be mentally prepared. If CIT gets angry, he will cancel your registration. See, cancellation is the authority of CIT. If he wants, he will do, or he may ignore it also. But you should be scared about the fact that if you carry business which is not incidental, or even if incidental, if you don't maintain separate books, your registration is subject to cancellation. A for when you made the application, your application form was incorrect. You know, this is which application? See, every trust, when they apply for registration to CIT, you have to apply, you have to fill application form. So this application form was incorrect. This CIT is realizing now. See, earlier when trust has made the application to CIT might not have noticed. He just saw the application, he granted the registration. And he is also human being, na? So that time he didn't see the application form properly. Maybe he saw also, but that time he didn't feel that something is incorrect. But after some years he realized, oh my God, your application was having incorrect data. I got fooled. I gave you registration. Now cancel. See, this discovery is happening later. Which discovery? that your application was incorrect. Whereas if you see application was done in past, you got the registration also, but CIT feels that why didn't I realize that your application was incorrect? If he would have known earlier only, he would not have granted registration. But maybe earlier he didn't pay much attention, so he granted the registration, but now his eyes are open. Now he is realizing that your application form was incorrect. I didn't even notice and I granted you registration. Now I will cancel it. So A for if CIT discovers that your application form for registration was incorrect. L, if CIT discovers that you are not complying with other laws. Here also you can have a doubt. Sir, CIT has already done the check, na? That only if you are complying with other law, he will grant you the registration. Correct. See, when you applied to CIT, that time you might be complying with all the laws. So he had a good image of you. He granted you registration. But suddenly trust might have become a bad trust. They started doing destructive activities. They started not complying with other laws. So if CIT comes to know, he will cancel your registration. So what was the last point? L. Non-compliance with other law if CIT notices. See, basically what they are trying to say, that currently you are complying with all laws, so we are giving you registration for 5 years. But be prepared. If we come to know later that you are not complying with other law, we will cancel. What was it? 5 years? At a stretch you get registration for 5 years. Yes, renewal can be done for 10 years if that condition is satisfied. But indirectly they give you warning that see, we are giving you registration because currently you are complying with all the laws. But if we notice in future that if you are not complying with laws, then your registration will be cancelled. So even this is one of the reason for cancellation. But sometimes CIT has put an allegation on the trust that you are not complying with other law. But trust is not agreeing. They are saying we are complying with every law. How can you say we are not complying with that law? So there is a dispute. So until that dispute is resolved, cancellation will not take place. See, there are two possibilities. CIT says you are not complying with other law and trust has agreed. Yes, we are not complying. Then immediate cancellation will take place. But sometimes CIT might put an allegation that you are not complying with other law, you are not complying with other law, but trust is not agreeing. They are of the opinion that we are complying with every law, so dispute is going on. And until that dispute is settled, cancellation will not happen. Even this is written in the law, because see, sometimes CIT can simply blame them. You are not complying with other law, so trust has got right to fight. They have got right to fight, and if they fight, if they dispute, so we have to wait for the dispute to resolve. And once it is finally proved, yes, you are not complying with other law, then only cancellation can take place. See, basically this is purely a theory question. Generally a straightforward theory is not expected in exam. But you never know, CA final paper, how they can test on any point. You should be mentally prepared. I would not say it is not important, but little less important because a straightforward theory is not expected. Mostly they will ask you sums. Okay. Now see, all these things should happen together or any one point. Any one point. Either G or C or O or R or B or A or L. Any one thing happens from GC or BUL, your registration is subject to cancellation. These are called what? Specified violations. See, violation means you are violating. You are not following the rules. So under these situations, we call trust has done some specified violations. Now tell me, if this thing happens, what will CIT do? He will not directly cancel. Look, first he will send you a notice. CIT will first send a notice to the trust. In the notice, what he will write? That we have realized that your activities are not genuine. GG. Or what was C? we have realized that your activities are not in conformity with the conditions for registration, or we have realized that you are not complying with other law. Is whatever has happened from GC or BUL, that CIT will intimate to trust, and they will tell trust that we are planning to cancel your registration. You tell us why shouldn't we cancel, and then he will ask for some records. Here, trust will have to furnish some information and documents with which they can prove that we are genuine. CIT, you are misunderstanding us. See, CIT can have misunderstanding of GC or BUL, na? See, GC or BUL are situation which can make CIT angry, but sometimes it can be a misunderstanding. So first CIT will give a notice to the trust, and then trust will submit some information documents with which they can establish that we are not doing any violations. And there will be meeting also between the trust people and CIT. And after discussion and after detailed inquiry, if CIT is convinced that trust is at fault, they have confirmed done some violations. If CIT is fully convinced after meeting the people of trust, he will cancel your registration, and that can be done by passing cancellation order within 6 months from the end of the quarter in which this notice was issued to the trust. See, let's assume this notice was given to the trust in the month of, say, 15th Jan. On 15th Jan, this notice was given. Which notice? Telling the trust that we have come to know about specified violations, we are planning to cancel. So when that notice was given, assume it was 15th Jan. So now how to count? 6 months. End the quarter. 15th Jan comes in the last quarter, Jan, Feb, March. So quarter will end in March. After that 6 months, within that 6 months time, CIT will pass cancellation order. So 6 months is counted from end of the quarter when this notice was given to trust. Tell you, when will CIT give the notice? That can happen anytime. The moment CIT feels GC or BUL, he will send a notice. And once the notice is sent from the end of that quarter, within 6 months your registration will be cancelled. Now tell me, how will CIT come to know that something from GC or BUL has happened? So see, there are 3 sources. Either CIT comes to know on his own. He himself noticed what? GC or BUL. Like, what was G? Activities of the trust are not genuine. What was C? Activities of the trust are not in accordance with the conditions for registration. This he himself noticed. So this is called CIT came to know on his own. Or AO will give the report to CIT, because assessing officer generally does the assessment of the trust. So sometimes AO will complain CIT, sir, this trust, they are not good people, they are doing GC or BUL. So AO will report to CIT, or CIT will automatically come to know through RMS. You know what is RMS? Risk Management Strategy of CBDT. Risk Management Strategy of CBDT. You know, this strategy of CBDT I had explained in income escaping assessment in the topic of assessment procedure. You know, this is a strategy where CIT automatically comes to know, because you know, this team of CBDT, they keep gathering information from here and there, here and there, here and there, and suddenly some information discovers GC or BUL. Means that CIT will come to know in his computer only. Means it is automated. In his computer only CIT will come to know, oh my God, Swami Vivekanand Trust is doing GC or BUL. It is automated method, which is devised by CBDT, and that is called risk management strategy. Here what is the risk? Trust, they are portraying as if they are good people, but they are bad people. It's a risky thing. For that, CBDT has made a strategy. Okay. In short, either CIT will come to know through automated information technology method, that is called risk management strategy, or AO will tell, or he will come to know on his own. The point is what, how he came to know is not relevant. Once he comes to know that GC or whirl is happening, step 1 he will send a notice, and then trust will furnish information to prove their genuineness, and if they are able to prove, then it's okay, cancellation will not happen. Otherwise the trust registration will be cancelled. So this is the theory of cancellation of registration. Tell me, what is the effect of cancellation? Henceforth trust will not enjoy exemption under section 11 and 12. Now see, after the theory for cancellation, now we can do exit tax. Exit tax. See, what is exit tax? Now see, exit tax means what, sometimes a charitable trust exits the world of charity. See, normally charitable trust has an objective of doing good for the people, good for the public, either charitable or religious thing. But sometimes, after doing charity for so many years, they have decided no more charity now. They are taking the exit from the world of charity. What do you mean by exit? See, this is the meaning of exit. Either, look at the keyword CMD. Can you see CMD? Either a charitable trust has converted itself into non-charitable. Up till now it was charitable, but they have converted itself into non-charitable. Or they have merged with some profit-making entity. Like there was a hospital which was giving treatment for free or treatment at a very nominal price. Now it got merged with a big private hospital which are totally profit-minded people. So when you merge with some profit-making entity, you have taken the exit from the world of charity. Then dissolution means a trust was doing charity up till now. Now they have decided to dissolve the trust. So dissolving the trust is also what? You have left the world of charity. In short, feel the word exit. Exit means you have left the world of charity. Okay, and leaving the world of charity means either you converted into non-charitable or you got merged with some non-charitable profit-minded people, or you have dissolved your trust. Anything from this happens, it is called exit. But you know what law says? It is not simple to take the exit. If you exit the world of charity, you will have to pay exit tax. Means for a charitable trust, it is not simple to take the exit. If they want to exit, no one will force them. No, don't exit, do charity. It's their choice. If they want to take the exit, they can take, but they have to pay exit tax. You know how much tax they have to pay? Look, we will have to see the balance sheet at the time of exit. At the time of exit means at the time when they look at CMD, when they converted into non-charitable, when they merged with non-charitable people, when they dissolved. So we will see the balance sheet on which date? CMD date. You understand my short form, na? CMD, which I have written. So we will take the balance sheet, and in that balance sheet, whatever assets are there, on that 30% tax plus 12% surcharge, fixed 12%, plus 4% health and education cess. Do it on your calculator. What amount it comes to? See, 30% is a basic tax, plus 12% is surcharge, plus 4% health and education cess. So effectively the percentage comes to 34.94% here. And I want you to by heart this only, because in exam you can directly calculate 34.94%. This much tax trust will have to pay, and then they can take the exit. Now what is the logic behind this? See, this is the rule, and if you want to by heart the rule, by heart. But that is not a good mentality, na? You should know why. Why we have to pay this exit tax? So his answer is kind of right. Basically, this tax is for withdrawing the exemption. You know, throughout the life, charitable trust has enjoyed exemptions. So that exemption government wants to reverse. But then don't you think it feels bad that when we did charity, you gave us exemption, 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 now you want to withdraw? But see, government will not withdraw full exemption. Listen carefully now. Look, assume there was a trust. Let me explain with figures. Huh? There was a trust which was doing charity for say 10 years. For 10 long years, they did full charitable activity. They worked like a good people, okay? And during that 10 years, their total income was 1000 crores. Just assume this is income of all 10 years. So they want 1000 crores. But out of which 600 crores income they have actually spent on people. They did charity. Like they distributed food to poor people. They used this 600 for giving treatments, free treatments. Means 600 was literally spent. But 400 crores assets they created. What was their original income? 1000 crores they earned in their last 10 years when they were doing charity, charity, charity. But out of 1000 crores, 600 crores they have spent. They have used it for charity. Means using for the benefit of people. But 400 crores, they created hospitals, schools, they created assets. Asset means what? Hospital building, school building, air condition in the hospital, furniture in the hospital, anything. Means feel the word asset, asset. So out of 1000, 400 was asset created. And you know one thing, even if you create asset, you get exemption. Tell me, how does trust get the exemption? 15% always exempt. But for balance 85%, you have to apply. Apply means what? It also includes capital expenditure. This I have told you now, that when trust applies the income, even if it is applied in the form of capital expenditure, like purchasing school, constructing hospital, even that is allowed to be deducted. So exemption was given for 400 also, exemption was given for 600 also. In fact, full 1000 crore might have got exempt. But you know what law says? This 600 crore which was exempt, we don't repent for that. Because that 600 crores you actually used up. You have used up on the people. But 400 crores is an exemption which is lying in the form of asset. You know, when trust created hospitals and school, for that also why government gave exemption, thinking what? With that school and hospital, charitable activities will happen. But now the school and hospital will not do any charity work. So that's why government says this exemption of 400 crores we want to withdraw. See, the word is accreted income. Accreted means the income which is accumulated by you in the form of asset, that we will tax. The income which you have spent, which you used up, that was exempt, it will remain exempt forever. That exemption we will not withdraw. See, understand the feeling of the government. You know what is going in their mind? From that 1000 crores, 600 crores income was exempt and it was applied in normal revenue manner. Revenue means it was all routine expenditure and this 600 crore is spent. Spent means it even trust is not having with it. It is used for the benefit of people. So this exemption government cannot withdraw, no? If government withdraws everything, then what will people say? That they are giving exemption, but one day when we stop charity, they will withdraw everything. So that would be unfair. So see what law says, don't think where we are withdrawing all the exemption. Your income was 1000, out of which 600 crores which was exempt, let it be exempt. Because that 600 crores, it is not there with you. It is spent on people. But what about the balance? Balance is what? This 400 crores. This 400 crores asset, how did it come? It came from income only, na? Tell me, does asset come from the sky? No. Assets are created from income. And when trust created assets, you are getting deduction for that also. Where exactly? After you deduct 15%, you minus applied in construction of school, hospital, you were allowed the deduction. But that income which was allowed as exempt, it is still lying with you in the balance sheet. That we are not going to leave it. That we will tax. Because those assets, whether it is school or hospital, we had the hopes that with that school and hospital, charity will happen. But now you are saying we will not do charity. So pay the tax on that. That's why, what is the name of this tax? Tax on accreted. What do you mean by accreted? Accumulated. Accumulated. See, trust income can be classified into two parts. Income which is used up and income which is accumulated. Only the accumulated portion which was exempted earlier will now be taxed. Okay. That's why, government's eyes are on the asset side. Because what is there on asset side, it is built over the period of time out of exempt income. Now government wants to tax it. But now what a trust will say, but why are you taxing this? We did charity for 10-15 years. Now we want to dissolve. And dissolving is our right. Like see, if I was doing charity for 10-15 years, now I myself have become old. I am hardly able to take care of myself. How can I do charity for people? To feel a genuine situation, I am saying that for so many years I did charity that you didn't see. Now I want to dissolve. Let me dissolve now. Why you want tax on that? So what government says, if when you dissolve, you will encash all this. You cannot encash. This was meant for doing charity. Like assume this 400 crores was a school. It was a hospital. It was meant for doing charity. Now when you're dissolving, you will encash it. And you cannot encash it. It was meant for public. And when you encash it, you will eat up the money. So that we cannot tolerate. Yes, if you want, you give this 400 to some other trust. This way, if you dissolve, no exit tax. This was very important, but did you hear? See, trust is saying what? That so many years we did charity, now let us dissolve. So what law says you dissolve? Dissolving is not a bad thing. Someday or the other, someone has to dissolve. But if you want to dissolve, don't encash this and keep it in your pocket. Whatever assets you are lying in balance sheet, whether it's a school or hospital, if you are not able to do charity, give it to some other trust. That means, see, if this assets of 400 crores, I give it away to some other trust, saying what? That I don't want to do charity, I am old now, I am dissolving. These assets you keep, you do charity. Give it away free of cost. Then there will be no exit tax. But if I say, no, why will I give free of cost? I will sell this because on dissolution we sell the assets. If you sell, tell me, if you sell, what will happen? Let's assume this 400 crores assets you sold at a selling price of 500 CR. So first there will be capital gains of 100 crores. That will be taxed. If long term 12.5%. And this 400 crores will also be taxed. See, I am dissolving, and on dissolution I am encashing my assets. If I encashing the asset means what? And selling it off. So tell me, if I encash the asset by selling this, so when you sell, it will have some selling price, na? 400 crores is like a cost price. And if you sell it, say for example, if you sell it for 500 crores, then there will be again a profit. That profit is what? 100 crores. That will be taxed like a normal capital gain. What is the rate for long-term capital gain? Assuming long-term, 12.5%. So that is normal tax. Plus, on 400 crores also you will have to pay the tax. This is if you dissolve by encashing the assets. But if you don't want all this tension, then what you can do? Give all these assets to some other trust. If you are not able to do charity, so this is a hospital, give it to some other hospital trust, they will do the charity. And if you give it away, all your assets, then you will not have to bear exit tax. In short, dissolving the trust is not a crime, but dissolve systematically. Throughout your life you did charity, na? Now on dissolution also you do charity. Doing charity means give all your assets to some other trust. And for that you are given 12 months time. 12 months from the end of the month when you dissolved. You know why government gives you such a long period? Because dissolution is a long process. In my balance sheet it looks so simple, 400 crores, one asset. But in real life, in the balance sheet of the trust, there can be 10, 15, 50 assets. And dissolution is a long process. So what law says? We will wait for 12 months from end of the month of dissolution. And in 12 months period, if we can see that you are giving away one by one everything to some other trust, then don't worry, hats off to you, no exit tax. You are always good, now also good. Leave the world of charity without tax. But in that 12 months, we noticed that one by one you are encashing your assets. So when you encash, that capital gain will come. That will be sale price minus cost price. And on this value, you will have to pay exit tax also. In short, every trust who dissolves will get 12 months period where government will do wait and watch. This 12 months is the fixed rule by heart. 12 months, 12 months. And only after 12 months expire, you will have to pay 34.94. Till 12 months, government will not say you a single word. After 12 months, when we came to know, oh, you didn't give it away to other trust, you encashed everything, then once the 12 months expire, you will have to pay exit tax. There is exactly a time of 14 days from the expiry of 12 months. You will have to pay exit tax. 14 days is also fixed by heart. 14 days, 14 days, 14 days. Within 14 days from the expiry of 12 months, you will have to pay exit tax. If these assets you encashed, you are not given away to other trust. If you give it away to other trust, then obviously no exit tax will be payable by you. See, this is for dissolved trust. Huh? Those who got merged with some profit-making people, immediately you will have to pay exit tax within 14 days. 14 days from the date of merger. See, 14 days is a fixed rule. But for dissolved trust, 14 days as time. Only after dissolution 12 months gets over. After that 14 days you have to pay exit tax. But exit happens in conversion and merger also. Na? Look at the top of the screen. So in case of conversion and merger, immediately within 14 days you will have to pay the exit tax. But in case of dissolution, government will wait for 12 months. Now see, this was just explanation in a casual manner. Actually, this 400 crores, how to calculate, even that is a big theory. See, for simplicity, initially what I did, I directly gave you some 400 crores amount. Basically, initially my target was to explain the concept and the thinking behind this provision. But now once you know the provision, I will explain how to exactly do the working of 400 crores. Because once 400 crores is properly arrived, then multiplying by 34.94% is not a great job, na? And even this comes in the exam as a question. You know what they do? They will give you one big balance sheet. And from the balance sheet, you have to do the valuation of assets. See, 400, don't think it will be given a ready-made figure like this. A big balance sheet will appear in the exam and you will have to do valuations. And then at the final value, say for example, 400 crores it comes to. On that, you have to apply the percentage. Okay. See, I have kept that thing ready for you to explain. Look, with this balance sheet, I will explain how to do working of 400 crores. But before that, one more thing. Tell me, when it is called that trust has taken the exit from the world of charity? In CMD cases. Okay, so look, this I will explain in more detail now. What is the full form of CMD? Conversion into non-charitable, merging with non-charitable, and dissolving your charitable trust. Okay. See, whenever I say charitable, it also includes religious trust. Huh? Now tell me, what do you mean by conversion? Earlier I said casually that you converted into non-charitable. But you know, when it is said that you got converted under three situations, look, it is said that you converted to non-charitable. See, this C is into three parts. Finally, you know, you will have to buy at this keyword. CMD, CMR, CMD, CMR. What is the keyword CMR for? What is the meaning of conversion? So see, if your registration is cancelled, then law will assume you are no more charitable, means you got converted. So cancellation of registration means also conversion. You know, some time back I explained the theory of cancellation, GC or bull. So whenever GC or bull happens, your registration will be cancelled. And cancellation is not simple. On cancellation, you have to pay exit tax. You know what is the effect of cancellation registration? Henceforth, you will not get exemption. And when your registration is cancelled, it is said that you are converted to non-charitable, and for that you have to pay exit tax also. That's why you know that theory of cancellation, GC or bull, is a dangerous thing. Why dangerous? Because henceforth your exemption will stop. Plus, you will have to pay exit tax. Then, sometimes you know you modify the objects of the trust. Like see, there was a trust, it was running hospital up till now. Now suddenly they felt we don't want to do hospital and all, we want to run schools now, colleges. So they are changing their object. If you want to change your objects, you have to ask income tax department. Because when they granted registration, that was keeping in mind hospital. Suddenly you want to start a school. You want to change your objects from medical to education. You have to take the permission. But if you don't take the permission, you are automatically converted to non-charitable. Is in the eyes of law, you will be non-charitable. Although see, people who were running hospital, now they are running school, they are still doing good job. But if you want to change your objects, you have to take the permission. Okay. And without permission, if you change your objects, it is said that you are converted to non-charitable. And what is the impact? Pay exit tax. Then look at this. There are two possibilities. Either you didn't apply for modification, or you requested, let us do school now, we did hospital, we are not liking hospital thing, we want to do school, college, education, we requested, but CIT did not allow. Sorry, we will not allow you to modify your objects. They rejected, but still I am continuing. Still I am continuing like ill-mannered. What did CIT say? We will not allow you to modify the object. Even if they rejected, look, still I am continuing the new objects. So even that will amount to what? Conversion. See, I am explaining what? What is the meaning of conversion? See, in CMD, M is simple. Merger means what? Merger. When you merge with some profit-making entity, it's a merger. Dissolution is also simple. But did you feel what is the meaning of conversion? Conversion is a general term. So in conversion, these things are covered. First was cancellation. Second was modifying the objects of the trust without applying. Apply cross means you didn't apply. You directly modified. Or you applied but they rejected. But still you are doing modified objects which they rejected. So all this will amount to what? You have to pay exit tax. Then registration. You know, when you take provisional registration, you get provisional registration for 3 years. Then at least 6 months prior to the expiry of 3 years, you have to convert your provisional to regular. You have to convert that now. But if you don't convert, then exit tax. Because see, provisional registration, if you don't convert into regular, you know what law feels? 3 years you enjoyed the exemption under the name of provisional registration. See, firstly, do you know, even if you're provisionally registered, you can get exemption. You know what government feels bad? 3 years you got provisional registration, and provisional registration, you know, it is easily granted without inquiry. And by taking provisional registration, you were enjoying the exemption. But now it is your duty to convert into regular, but you are not converting. So whatever 3 years exemption you enjoyed, out of that which you assets which you created, on that you have to pay exit tax and get lost. Get lost. Why government is getting angry? Because those who have taken provisional, they should convert into regular. But if they don't convert, why government is feeling bad? Because 3 years you enjoyed the exemption, and with that exempt income you created assets, so you pay exit tax and get lost. And sometimes, you know, registration you don't renew. You know, trust is expected to renew the registration every 5 years. Now it has become 10 years. But tell me how to renew. Whenever your 5 years period is going to expire, at least 6 months prior to the expiry of 5 years, you have to renew. But if you don't renew, then also you have to pay exit tax. Because you know what government will feel? Oh, you came for time pass just for 5 years you enjoyed. Now you are not renewing the registration. That means you are leaving the world of charity. So what will happen? During 5 years period you enjoyed the exemption, and out of exempt income you created assets, you pay tax and then get lost. See, in short, here there are two things. Either provisional to regular you didn't convert, or you didn't renew your registration. So in short, this shows what? There are so many situations when exit tax can kill you. Tell me how many situations. Count and tell me. Cancellation. Even cancellation come in several situations. GCORBAL. So firstly, so many situations were there for cancellation. Then modification also, there are two possibilities. Some people don't apply for the new objects, they directly do. Or some people they apply but they got rejected, but still they are doing modified objects. And in registration, some people what they do? They take provisional but they don't convert into regular. Or your regular registration of 5 years you don't renew. You know, this is all called C in CMD. Plus merging with other non-charitable people. Plus dissolution. All this will lead to exit tax. See, basically, in this whole concept, you know what you have to study? Why exit tax? When exit tax? And how to calculate exit tax? 3 things I have to explain. Firstly, why exit tax? I explained. Because so many years you enjoyed the exemption, and out of exempt income you created the assets. So, why thing I explained. Then, when exit tax comes, CMD, CMR. What is CMD, CMR? CMD is the main keyword, or under C, there is CMR. What is CMR? Cancel, modify, registration. Okay. So, why exit I explained. When exit tax, CMD, CMR. Now, how to calculate exit tax? That I will explain. See, this was just a short explanation. That on the value of asset 34.94%. But that is not a proper explanation. Now comes the proper explanation. See, in exam they will give you a balance sheet. And balance sheet will be given on which date? Look, CMD date. What is CMD date? Conversion, merger, dissolution. See, even if the trust is dissolved, the balance sheet which you take will be of dissolution date. Whereas exit tax you will have to pay after 12 months. I told you na, Whenever a trust is dissolved, government will wait and watch for 12 months. Maybe during 12 months they give away all their assets to another trust, then we will not levy exit tax. So although government is waiting for 12 months, but in case exit tax is to be levied, the base balance sheet will be on dissolution date. Whereas actual payment of tax will come after 12 months, and after that also there are 14 days, if you remember I said that. So actual payment will come at a later date. But for calculation purpose, balance sheet will be as on exact dissolution date. So in short, see, please respect this also. Balance sheet as on CMD date. Anyways, this thing, even if you don't care much, in the question they will already give you balance sheet. But I am just telling you, the balance sheet given in the question will be on CMD date. Now, on liability side, you will find corpus, reserves and surplus. All this you will ignore. See, basically the structure is asset minus liability. You have to calculate net assets. On that net asset, you have to apply 34.94%. But in net asset, you will subtract normal liabilities. You don't subtract corpus, because corpus is not a liability, na? It is just a share capital kind of thing. So corpus, reserves and surplus. Then what is the next thing? Provision for unascertained liability. You know, sometimes the liabilities are not ascertained. We don't know how much we will have to pay. We have simply made a provision. So this is kind of a reserves only. See, only thing is, things which stand as reserves, they are like free profits. But from the reserve, if you keep aside some amount for some uncertain things. So uncertain things are uncertain things, huh? But now you are dissolving. So that is kind of a reserves only. See, if the liability crystallizes, oh, we have to pay 1 lakh to someone, then it is a proper liability. But here the liability is not crystallized. See the word. Provision for unascertained liability. Something is uncertain, for which if you make the provision, it is as good as reserves only. Then excess provision for tax. See, taxes which you pay to government, that is your real liability. But if I have to pay tax of 1,000 and I create provision of 1,100, my tax is only 1,000 and I create provision of 1,100, so 100 rupees is extra provision, and that extra provisioning was done from reserves only, no? So that is kind of reserves. Means full provision for tax I am not saying ignore. Excess portion. Even the question they say provision for tax was 1,100, whereas the actual tax liability is 1,000. So how much is excess provision? 100. In short, see, although in my balance sheet I am saying ignore 4 things, but actually I am ignoring 2 things only. Capital and reserves. Only thing is, these 2 items appear like provision, but they are kind of reserves only. So by heart these things, you will ignore corpus, you will ignore reserves, you will ignore provision for unascertained liability, you will ignore excess provision for tax. All other liabilities you will subtract from the total of assets. Now, on asset side, whatever assets are given, you have to value it. Like see, on asset side you might have shares and securities. S for, see there is a keyword I have made, SUBIO. By heart this, SUBIO, SUBIO. In SUBIO, S stands for shares and securities. How to value shares and securities? Average of stock market price. You know, this shares means what? In the balance sheet of the trust, they have made investment in shares. See, trust gets lot of money by way of donation, and many times they keep it invested under 11.5. And under 11.5 there are some share investment also. And if the shares are listed in stock exchange, so we will have to see stock market price. Stock market price as on which date? CMD date. Is as on CMD date, what is the stock exchange price? But tell me, CMD date is one day, na? And within the day also price fluctuates. So we will take the average of highest and lowest price as on CMD date. See, I am stressing on a day. Balance sheet is on which day? CMD. So on that day, it's a day, na? And in a day also, stock market price fluctuates. So you will take which price? Average. Average of not opening and closing price, highest and lowest. See, opening and closing means what, price at which stock market opens. Closing means price at which stock market closes. Don't see opening closing. In the question, they can give it for confusion. You will see the average of highest price on that day. Which day? CMD day. And lowest price on that day. So that is the value of shares and security in the balance sheet of the trust. Then, look at this. I stands for, let me explain this I first. I for immovable property. How to value immovable property? Stamp duty value or fair market value, whichever is higher. FMV and HDB, whichever is higher. See, generally for immovable property, we put reliance on HDV, stamp duty value. But stamp duty value are the fixed values by state government for stamp duty purpose. Whereas in open market, the value may be little different. So we'll see the one which is higher. Higher because government is greedy. So higher of what? FMV and stamp duty value, whichever is higher. Then O stands for any other asset will be taken at FMV. S is done, I is done, O is done. Now, U stands for unquoted equity shares. Unquoted. Unquoted means they are not listed in stock exchange. And generally, private company shares are not listed. So imagine our trust has invested in some private company. See why I am using the word private company? Because I want to create an atmosphere of unquoted. U for unquoted. So see, imagine our trust has invested in some private company. And we have got some 20% shares of the private company. How to find the value here? See, private company share, you will not get the stock market price. Huh? So what to do? We will have to bring the balance sheet of that private company. We will have to bring the balance sheet of that private company. That private company means the company whose unquoted shares we are holding. So see, in the question they will give you. Look at this. Balance sheet of, see why I am stressing on private company? Because unquoted equity shares are generally of a private company. Because private company share you will not find listed in stock market. So that's why what is difficult for us to find the stock market price. So that's why we will take the balance sheet of the private company. And here also rule is same. See, look at the balance sheet. In liability side you will ignore capital. See, now I have not written the word corpus. Because this is a trust or a normal private company. That right hand side balance sheet is of a normal private company. There you will find capital. So tell me in liability side what I have cancelled? Capital, reserves, provision for unasset and liability, excess provision for tax, ignore that. And then asset minus liability. But here the keyword is SUGO. SUGO. What is the full form? What is S? Shares. Now these are shares in the balance sheet of that private company whose unquoted shares trust is holding. But the valuation method is same. Average of stock market price. Then in that private company, you might have unquoted shares of another private company. So take that another private company's balance sheet and do the valuation. But that much in depth, it will not be given in the exam. But obviously, if that private company also has got unquoted shares, so we will have to do valuation based on that another private company. But all that, don't worry, it will be given ready-made in the question. And then in SUGO, J stands for jewelry and bullion. Jewelry will be valued at FMV. Tell me, this is jewelry in whose balance sheet? Not in the balance sheet of trust. It is in the balance sheet of that private company whose unquoted shares I am holding. Then immovable property, FMV, HDB, whichever is higher. Other asset like data, stock, bills receivable. See, in this private company, you will find routine assets, bank balance, FDs, data, all will be taken at book value. So tell me, after you add SUGO, you will subtract other liability. This will give the valuation of that private company. But that is the value of the whole company. Do I own the whole company? I am trust. See, trust is not owning that whole private company. You might be having some 20% stake. So whatever valuation you find, multiply by our percentage holding. Our means we are trust. So see, in this private company, assume trust is holding 20%. So what to do? Whatever valuation you arrive with the balance sheet of that private company, take 20% of that, and that will come here in our valuation. Okay. Then B stands for what, business undertaking of the trust. If a trust carries on business, it has to maintain separate books. And if separate books, balance sheet will also be separate. See, separate balance sheet here. Look. See what I have written. Balance sheet of business undertaking. See, this is our business only. We are trust. But what law says, if a trust is carrying on a business, it should maintain a separate books. And if you have a separate books, our balance sheet will also be separate, na? So in that separate balance sheet, again you will have to do separate valuation. And here full valuation will come here. And here also valuation rule is same. Same means what? SUGO minus other liabilities. What is SUGO? Shares and security, unquoted equity shares, jewelry, immovable property, other assets. The only difference is, in this private company, we might be having say 20-25% stake. So we'll take that much only. But this business is our business only. Full amount will come in valuation. Okay. The best to remember this theory is what SUBIO, SUGO, SUBIO, SUGO. See, when I'm saying this, when I say SUBIO, it is sounding intense. But when I say SUGO, it's sounding little low. This shows what our main keyword is SUBIO. Then SUGO is a working note. You understand what I'm saying? SUBIO is a main answer. And in working note, I will do SUGO twice. Why twice? One for that private company's valuation and other is for our business, of which we have maintained separate set of books. Okay. See, here I am explaining everything in depth. But practically when question comes in exam, they will not put everything, na? But when we are studying the provision, we have to study everything in depth. And in one page I have covered everything. It's the same thing if you see in study material, it's running into pages and pages. You will get messed up. You will not understand where are you going. At least here you have the link that this is the main working, SUBIO. And in SUBIO, this two valuation will come from working note. And what is the keyword for working note? SUGO. Now, one more thing. Look. Tell me in SUBIO, look at SUBIO, we have taken all assets practically. Everything we have taken. But some assets you have to ignore in SUBIO. You know which assets? If in the balance sheet there are some assets which trust acquired under their unregistered period. Feel. Like see for example, in SUBIO there is an immovable property. I for immovable property, which trust claims that this immovable property we purchased long back. It was in a time when we were not even registered, and when we were not registered, we were not getting exemptions, we were paying the taxes. So we have acquired the property out of taxed income. Then why exit tax? See, exit tax is for what? If your assets are built, created out of exempt income. An exemption is granted when you are registered. But if I can prove that my assets were acquired in those days when I was not registered. So when I was not registered, my return was filed with full taxable income. And out of taxable income, if I create the asset, they cannot levy exit tax. Okay. So in SUBIO, if by chance there is some asset which you acquired during your unregistered period, ignore it in exit tax. Then three things are there. Three things. This is one. Second, if the trust is dissolved and during the 12 months period after dissolution, they have given away few assets to another trust. So given away to another trust, good. No exit tax on that. Means imagine the trust has dissolved, but on dissolution, few assets they have given away to other trusts. Only few. But few you gave, na? So that many assets you will subtract in exit tax. Because see, I told you sometime back, dissolved trust, they have an option. If they give away all their properties and asset to another trust, free of cost, then they will not have to bear exit tax. But sometimes, a trust which is dissolved, it has not given away everything. They have given few of their properties to another trust. So that much credit they will get, na? See, I am explaining three things which you have to ignore in SUBIO. First was assets acquired during unregistered period. Then assets given away to another trust within 12 months from the end of the month of dissolution. Then third point, assets acquired out of agricultural income. Like see, in SUBIO, we have got few assets which I am saying that these assets I have acquired out of agriculture income. And agriculture income is directly exempt. See, all other exemptions, government has done obligation for which there is a condition that you do charity. But agriculture income is a free exemption. Na? Free means without doing any charitable activity. Once you have agriculture income, it's exempt forever. And with that income, if I have acquired a property, no exit tax. Because agriculture income is exempt for we people also. Na? So government cannot punish a trust that you have got asset which you acquired out of agriculture income. So what? See, if I acquire something out of income exempt under 11 and 12, if I acquire something out of income exempt under 11 and 12, then exit tax is payable. But agriculture income is exempt under 10(1), which is exempt for everyone in India. So with that income, if you acquire the asset, you will not have to pay exit tax on that. So tell me which assets are exempt from exit tax. Look at the screen and answer one by one. Assets acquired out of agriculture income. Can you see I have put a small cross mark? Cross means no exit tax. No exit tax. So assets acquired out of agriculture income. Then what was this? Assets acquired between the date when the trust was created and the date when they got registered. Creation date and registration date. Means trust was created in 2010. They got registered in 2015. So from 2010 and 15, during that period, they were unregistered. Na? So assets acquired between which date? Between the date when trust was created and the date when they got registered. Indirectly, you can say asset acquired during unregistered period. Then what is this? On dissolution, you transferred your asset to another trust within 12 months. So if you find these assets in our question, don't take it in the valuation. Rest all assets you will take it in SUBIO, and on that you have to apply 34.94% tax. Okay. Now see, one more thing in this. When are you supposed to pay 34.94% tax precisely? Within 14 days. Sometime back I said, see, firstly 34.94, how will you calculate? 34.94 is of SUBIO minus other liabilities. Calculation is done, but now when to pay that? When to pay? Within 14 days of CMD. Now, counting of 14 days is also a big challenge. You know why? Because exit tax can come in several situations. So depending upon the situation, counting of 14 days is done. Like in case of dissolution, I have already told you how to calculate 14 days after the expiry of 12 months. See, I have written here. After the expiry of 12 months from end of the month when the trust was dissolved. For example, trust was dissolved on 23rd August. 23rd August. So end August. After that, September, October, November, this way 12 months. And after 12 months expire, from the expiry of 12 months within 14 days you have to pay. But that was under dissolution, na? But exit tax can come in several situations. So under different situation, 14 days counting will differ. So see what I have done, here I have written all these situations when exit tax can come, which I have already explained. CMD, CMR. What was the keyword? CMD. And under C, CMR. So tell me one by one. What is the first situation of exit tax? You get converted into non-charitable. And when it is said that you got converted, if your registration is cancelled. Okay, now let's assume your registration got cancelled on account of GC or BUL. Remember that? So tell me, when you will be paying exit tax? 14 days from which date? Yes, obviously you will say date of cancellation. See, cancellation is communicated. How it is communicated, see? See this? Whenever CIT cancels, he will communicate by giving a cancellation order. So once you get the cancellation order of registration, that is a sign of what? Your registration is cancelled. So generally what a student will say, yes, then whenever the cancellation order was received within 14 days. No. See, when CIT gives cancellation order to trust, it is possible that trust can file an appeal against that. See, trust will not sit silent. Imagine in this theory, when CIT passed a cancellation order to trust, trust was not happy. They felt, why the hell they cancelled our registration? We'll file an appeal. And this appeal will go to ITAT. Why ITAT? Generally, appeal starts with CETA. But CETA is Commissioner of Income Tax Appeal. And here, who has given you the pain? CIT. And you cannot take the complaint of CIT to CETA, na? You will have to go to ITAT, Income Tax Appellate Tribunal. And you know what is the time limit of filing appeal to ITAT? You forgot everything which I taught. Time for filing appeal to ITAT is within 2 months. From the end of the month in which CIT's order is received by the trust. See, appeal to CETA was in 30 days. But appeal to ITAT was in 2 months. So, government will wait for 2 months. They will not immediately jump on you, pay exit tax. You are cancelled, your registration cancelled. Trust will say, why? They have cancelled, but we don't agree. We will file appeal. And in case you go in appeal, until the matter is resolved, you will not have to pay exit tax. And appeal can go to first ITAT, then it can go to High Court, it can go to Supreme Court. Appeal will travel a long way. And until the finality comes, finality what? That finally your registration is cancelled. And trust, you people are wrong, CIT is right. Only when the final verdict comes, 14 days meter will start. Let's assume trust fought till Supreme Court. So when Supreme Court gives the final verdict that dear trust, your cancellation is proper. So that means the matter has come to finality. So from Supreme Court judgment date, 14 days you will count. 14 days counting is from Supreme Court judgment date. But balance sheet will be on cancellation date. What did I say? Balance sheet is on CMD date. And when your registration cancelled, so cancellation date is CMD date. So balance sheet you will be taking on cancellation date. But 14 days time you will count when? Not after cancellation. After cancellation you went in appeal. And appeal might have gone for 3-4 years. And when the final verdict came that cancellation is valid, then 14 days within that you have to pay the tax. In short, see what I want you to feel. Balance sheet is immediate basis. But 14 days will not immediately start. Obviously, if the trust is not agreeing with the cancellation, they are saying, for no reason you are cancelling, we'll fight. So let them fight. Only when they finally lose, they will pay tax within 14 days. But tell me, this is if the trust has filed the appeal. What if they don't file the appeal? We'll wait for the appeal period to expire. Because see, trust is not filing the appeal. They know they don't want to file the appeal. But IT department will wait. They will wait for full 2 months. What is 2 months? Time limit for filing appeal to ITAT. Why I am saying ITAT? Because if you are not happy with CIT, you have to go to ITAT only. This I explained in the chapter of appeals. And time for filing appeal to ITAT is 2 months. So if you are not filing the appeal also, still IT department will wait for full 2 months. And once that 2 months expire, then 14 days will start. In short, counting of 14 days depends upon what? Look at the screen now. If you did not appeal, can you see the cross mark? Cross mark means trust did not appeal. Then we have to wait for the expiry of appeal time limit. And what is the appeal time limit? 2 months from the end of the month when CIT's cancellation order was received. So whenever the time limit expires, after that 14 days will be counted. But this is if you didn't appeal. What if you filed the appeal? Can you see this tick mark? Tick mark means you filed the appeal. Then whenever the finality date arrives, finality date means final judgment which has closed the case in the favor of IT department. See, in final judgment, if trust wins, then registration cancellation will be ignored. Then you will not have to pay exit tax. No? If a trust is fighting and if they win the case, they are fighting for what? Why the hell did you cancel our registration? And if they win the case, the cancellation will become void. But only if the trust finally loses, we'll see the final date of they losing the case. And case can achieve finality at High Court level also, Supreme Court level also. See, once the judgment comes and the other party do not counter appeal, the case has closed. And once the case closes, that too in the favor of IT department, trust will have to pay exit tax. Then what was this modify? Explain modify means what? You requested for modify, that we want to modify our objects from medical to education. But you were rejected. So you are rejected. So whenever your modification is rejected, for that also you can file an appeal. Again same point. If you file the appeal, appeal will go on for years and years. Only when the finality comes, 14 days period will start. Means here what is the appeal for? Why are they rejecting the new objects? Up till now we were running hospital, now we want to run school, we are doing good for people only. Why are they not allowing us to modify the objects? We will fight. Here also appeal can start. And here also appeal starts with ITAT. In short, what I said here is ditto same here. Look, I have put a ditto mark there. Means here also the counting rule of 14 days is same. You know what I am explaining this? How to count 14 days. 14 days is counted from which date? Which date is taken as the base for counting 14 days? So tell me whether your registration is cancelled or you have gone for modification which was rejected, the rule is same. Now what was this? You modified the objects without even asking them. Not applied means what? You didn't apply for we want to modify, please let us modify, please let us modify. You didn't even apply. Let's assume they modified their objects in June. You know what law thinks? Okay, you modified in June. At least by the end of the year, you will apply. But the year got over. 31st March came. You didn't apply. Then you will become criminal. But you will become criminal on end of the previous year. So from the end of the previous year, 14 days you have to pay exit tax. Why end of the previous year? You know? Because see, when you modify the object, you are not applying. So although you modified the object in the month of June, but we are waiting for what? Maybe July, August, September, someday he will apply. But the year got over. End of previous year means March has come. Which previous year? The year when modification object took place. And whole year passed on. 31st March also came. You didn't apply means without asking our permission, you modified. So 14 days meter will start from the end of the previous year. You know, you might be thinking, sir, is it necessary to study so much in detail? They have asked question on this. See, trust my experience of so many years. If I am teaching something, it is not just random. See, if I would be a teacher of just 1 or 2 years old, so you can think also unnecessary, sir is explaining all this. What is the use of all this? So many years I have seen, and this 14 days has been tested. So 14 days anyone can buy it, but 14 days from when? So tell me, here it is from the end of the previous year when you modified object. Then what was this registration? Sometimes your provisional registration you fail to convert into regular. Tell me, provisional registration when you are getting it is valid for 3 years and you have to convert into regular. When you have to convert? When you have to convert? You forgot that, na? Provisional registration when you have to convert. At least 6 months prior to the expiry of this 3 years or within 6 months from the date of commencement of the activities whichever is earlier. This was taught to you. I repeat, whenever provision is to be converted into regular, what is the deadline? Either at least 6 months prior to the expiry of 3 years or within 6 months from the date of commencement activity, whichever is earlier. So, let's assume that whichever is earlier period comes in some August, okay, or September. So, end of that year. End of that year. So, for example, you should have, let's assume your activities commenced on this date and after that 6 months. So, in whichever is earlier, obviously what will come earlier? This will come whichever is earlier. And whenever this 6 months expire, that financial year's end. Means I am explaining when to pay the exit tax. Whenever that 6 months is what? It is a due date to convert your provisional to regular. If you don't convert, then whenever that year gets over, which year? When your conversion was due, but you didn't convert. So in that year, whenever the year ends, end of previous year, from that 14 days you have to pay the exit tax. Then renewal. When you are supposed to do the renewal? Whenever your 5 years registration period is going to expire, at least 6 months prior to that. So at least 6 months prior to that you have to renew. But if you don't renew, so whenever your renewal was due, that financial year end. Whenever your renewal was due, not the day when it was due, that year's end. See, here also it is end of previous year. See, ditto mark means everywhere it is end of previous year. Okay. But end of which previous year? In this renewal cases, whenever your renewal was due, that. And in case of conversion, whenever your conversion from provisional to regular was due. And for modifying objects, the year when you modified without asking, end of that year. Actually, only there are two sets of rule, this and this. See, when registration is cancelled or your modification is rejected, then it becomes a disputed appeal matter. Then the rule goes according to the appeal. But here it is not leading to appeal matter. Na? Here I am at fault that I modified without applying, or I was supposed to convert provisional to regular, I didn't do. I was supposed to renew, I didn't do. So when you were supposed to do something, you didn't do, so it's your fault, na? So whenever you are supposed to do, end of that year. Then if a charitable trust merges with non-charitable people, date of merger. From the merger date, you have to count 14 days. This is simple. Like on 1st July, a charitable trust which was running a good hospital, they got merged with private hospitals who are profit-making people. So that merger happened on 1st July. So from 1st July only 14 days will start. Okay. And in case of dissolution, from the end of the month of dissolution, wait for 12 months. And after the expiry of 12 months, within 14 days. So in short, in this page we have studied how 14 days counting is done under different situations of exit tax. Okay. Now see, I will immediately take one question on this. See question number 4. It is totally fresh right now only. See, this knowledge we have to show now. See, for solving the sum, this knowledge will be useful. See, this 14 days theory is little bit theoretical thing. It can come in MCQ anywhere, but sums are based on Subhayo, Sujiyo. So use this knowledge and let's solve this sum. First in the question what they've asked, read. Calculate the exit tax payable. And read this. State the latest day on which such tax should be paid. Means that 14 days knowledge. And by the way, this is an exam question. But I have modified this question to cover extra points also in this. See, what I do in my book, I take ICAI question only as the base. But in that, I will put other extra points also so that it becomes an exhaustive question. So the base question is of ICAI only. So see, they had asked two things here. Calculate exit tax payable and state the latest day when you have to pay the exit tax. Okay, means that 14 days thing. See, first let us figure out why this trust has to pay exit tax. Can you tell me why people have to pay exit tax? Because they have done anything from CMD, CMR. So in this question, let me show you what exactly has happened. Directly read this para. Please read this para. Read. Application for registration was made on 15th April 2015. Registration was granted on 1st July 2015. 2015 is old year. Huh? Now what has happened? This registration was cancelled. Feel the word cancellation. Means your cancellation is the root cause of exit tax. See, exit tax comes on account of CMD, CMR. CMD, CMR. So here in CMD, C, cancellation. Cancellation has occurred. And when was cancellation order passed? You know what is the rule for cancellation order? 6 months from the end of the quarter when cancellation notice was given to given by CIT to trust. In GC Herbal theory I had explained. So let's assume that cancellation order was passed on 31st Jan in the question. In the question it's given. Then An appeal was preferred against the order of cancellation. Means trust did not like cancellation. They filed an appeal which was dismissed by appellate authority. Means their appeal was dismissed. Means they lost the case. An order confirming cancellation. Confirming means appeal people said your cancellation is confirmed. Trust lost the case. And on 31st March, finality came. Finality. See, on 31st Jan, what happened? Cancellation order came. But we filed a case and we lost the case. And when did the final judgment came of losing the case? 31st March. This is called what? Finality date. I had explained here, na? See, when you go for appeal, you have to wait for the finality date. Finality date means what? The date when final judgment has come in favor of IT department and where trust has lost the case. So here it is clearly given, trust has lost the case. And that order of appeal came when? On 31st March. So can you tell me when this trust will have to pay exit tax? 14 days from finality date. Okay, because in this question cancellation has happened and appeal was filed, so finality date. So what is the finality date? 31st March. So count 14 days from here. 14th April. One question we have already answered. Read what was given. Read. State the latest day on which said tax must be paid. 14th April. 14th April precisely 2026. Okay. Now let us take the question from the top. Why they have given balance sheet? To calculate SU bio. In the main balance sheet you will do SU bio. So try. Use this rule. Strictly use this rule. Tell me in this SU bio balance sheet which items you have to cancel. Corpus, reserves, provision, blah blah blah. You have to cancel that. So follow that rule. Look. Firstly, can you see liability side corpus is there? So first I will strike off this amount. Then what else you have to cancel? Reserves and surplus, provisions, etc. What about other liabilities? That you will subtract from SU bio. So here this is what? Creditors is what? Other liabilities. This you will subtract. But wait. For this there is one adjustment. You want to see that adjustment? Read. Read this fourth adjustment. Read. Read this fourth point. Sundry creditors include 30 lakhs provided on estimated basis for contractors who have for which no bills are received. Tell me, contractors are not given the bill, the amount is provided on estimated basis. These things are called what? Read and tell me. Provision for unascertain liabilities. Unascertain means you don't know the amount what you have to pay. And see, how do I know it is unascertain? See, it was provided on estimated basis. Even the bills are not received. So this is provision for unascertain liability, which I said to consider or ignore it. Ignore it. So this I will have to strike it off. So see, how much was that? 30 lakhs. And what is the total creditors? 335. So see the breakup. Out of 335, I will ignore 30 lakhs in the liability because it is provision for unascertain liability. So what is the true liability for me? 305 lakhs. This I will subtract from SU bio. Okay. Now read. Asset side. Asset side, what is the first asset? Land purchased in 2012. This is what in SU bio? Land is immobile property. How to value immobile property? FMV, SDV, whichever is higher? It is given in the question, FMV, SDV. You want to see? See, this is the book value. This 100 is what? Book value. But I am looking for FMV and SDV. I will show you that thing. See here. Read this. This was a land purchase in 2012. See this. See this. Read this sentence. Read adjustment number 1. What is given? SDV of the land purchased in 2012. It is the same land which I am talking about, correct? 2012. See what is given? SDV as on 31st Jan. Tell me, balance sheet is given as on which date? 31st Jan. Tell me, what did I say? Balance sheet is always on CMD date. And here CMD means cancellation. When did cancellation occur? 31st Jan. Balance sheet is of 31st Jan. But exit tax you will pay within 14 days from the finality. And as on the balance sheet date, what is the SDV? 120 lakhs. But if sold in the open market, it would fetch 250 lakhs. So this is like FMV and this is SDV. You have to take what? The one which is higher. But you will not take this asset in valuation. Because see, the trust was registered on 1st July 2015. And when did you buy this land? 2012. You forgot. What did I explain here? If you have got some assets in SUBIO which you acquired during unregistered period. See, in unregistered period, your return which was filed, it was exempt return or taxable return? Taxable. And out of taxable income, if you acquire the asset, you don't have to suffer exit tax. Na? And here you should notice the date. Na? We were registered on 1st July 2015. And this land we acquired in 2012. Okay. So on this, exit tax will not come. So why the hell this was given? This was given for confusion. So that the student will take it in the valuation, but you should not take it only. So see what I have done, I have put a cross mark here. Means this will not be considered in valuation. Then see the next land and building. Again land and building means it is from SUBIO I. But when did you acquire this land and building? This is in 2018 when we were fully registered. So this I will take. See, I have put a tick mark. Can you see tick mark? But 800 is the book value. You will take book value or FMV SDV? FMV SDV. See, it's given here. What is the FMV? What is the SDV? SDV is 1050 lakhs. And its open market value is 1000 lakhs. You will take 1000 or 1050, whichever is higher. So what is higher? 1050. See, I have written also here 1050 you will take. So 800 you will not take, you will take 1050. Then what about 2000 quoted equity shares? For quoted shares you have to take what? Average of stock market price. See, average of stock market price is given here. Read. Highest and the lowest value per share traded on 31st Jan is 1099, 1051. Wait, this is of which company? X Limited. Are we talking about the same company? Yes. You should check carefully. 2000 shares of X Limited. And X Limited stock market price is given. So tell me, you will take 1099 or 1051 or average? Average. So average it. Average it 1099 plus 1051 divided by 2. How much it comes to? Tell me fast. 1075. But this is per share. Multiply by how many shares we have? How many shares we have? 2000. So 1075 it was, na? Into 2000 shares. It comes to 21 lakhs 50,000. See, this 21.5 is in lakhs. And see, I have put a tick mark. Tick mark means this we will take. But we will not take 20 lakhs. That is the book value. We will take the average of stock market price, which comes to 21.5 lakhs. Okay. Then Unquoted equity shares. This is what in SUBIO? You. But for this, we have to see the private company's balance sheet. Tell me here, this unquoted shares, are of which company? Z Private Limited. So I need balance sheet of Z Private Limited. So in the question they will give. See here, Z Private Limited, a summarized balance sheet is given. See, this is kind of a balance sheet only. See, I want balance sheet of Z Private Limited, agreed. And with this balance sheet I will do SUGIO. So use this information and do SUGIO. Now follow this protocol of balance sheet. Na? What you have to cancel from liability side? Capital, reserves, etc. So see, I will do that. First, 1 lakh equity shares is share capital. Ignore it. Then book value of assets other than bullion and jewelry. See, other than bullion and jewelry, why? Because for jewelry we have to take FMV. So bullion and jewelry FMV is given 30 lakhs. So what is 60 lakhs? It is other than jewelry. And for other items, what we do? Plain book value. SUGIO. So this will be taken at market value. Other assets will be taken at book value. Add 90 and liabilities subtract. So 90 is assets minus you subtract liability of 35. So it comes to what? 55 lakhs. But is whole 55 lakhs belonging to me? This whole private company is not mine. I have my stake. Look, we have to take our percentage. So how much is my percentage in this company? See, we are holding how many shares of Z Private Limited? 15,000. And there are 1 lakh shares in Z Private Limited. So out of 1 lakh, if I hold 15,000, my stake is 15%. So calculate 15% of that. That comes to how much? 8,25,000. How did I get this? 55 lakhs multiply by my percentage, 15%. Okay. So see, this tick mark means all these items you have to take. Okay. Then balance in FD with scheduled bank. Then where does it fall in SUBIO? The main balance sheet SUBIO. Huh? It is O. Bank FD is what? Other assets. And for other asset, what we do? We take FMB. But for bank FD, what FMB you have? This itself is the FMB, na? Same amount I will take. Same 200. See? Same 200. Cash in hand. Same 12. Cash doesn't have market value, no? What about TDS? This you will not take. See, I didn't say, but remember, on asset side, we will take everything, but don't take advance tax. Don't take TDS because they are itself income tax. And we cannot calculate tax on tax. See, what are we struggling to find? Exit tax. And exit tax is from the family of income tax. And TDS, advance tax given in the balance sheet, they are also from the family of income tax. So, although I didn't say, but it is implied that when you take SUBIO, please don't take TDS, advance tax and even miscellaneous expenditure. Like fictitious assets are there on balance sheet, which I didn't mention, but now I'm mentioning. Everything you take in SUBIO except TDS, advance tax because they are already income tax and miscellaneous expenditure item. Don't take that. So here we have got TDS, so don't take that. So see, everything I will take, but I will not take TDS. So see, answer is in front of us. Just add this black color. Add, take it on your calculator. This is total of sub-bio. But from sub-bio, you have to subtract the liabilities also. Answer is ready with us. The total of sub-bio comes to how much? Total of sub-bio is how much? 191.75. From that, you have to subtract the liabilities, which is 305 lakhs. So what is the answer? 986.75. Check. 986.75. See, how did I get? Simple. All the values I have assigned near the balance sheet in the black color. See, all the valuation I was writing one by one, side by side. Na? So this valuation is total of sub-bio minus a liability. It gives me the answer of what? 986.75. Then what is exit tax percentage? 34.94. So this is the exit tax payable. Okay. And this you have to pay within 14 days from the finality date. When the order confirming cancellation came, 31st March. From here 14 days is 14th April. So that's it. We have solved the question. This much exit tax is payable and we have to pay latest by 14th April. Okay. So in short, we have finished the theory of exit tax along with its question also. Okay. Now in this chapter, you know what is left? One small thing is left. Look here. There is one section 1023C which is from the family of charitable trust only. Okay. You know what does this section says? Once you are a hospital, look at this HE, HE. Once you are hospital or educational institution, you are directly exempt. You don't have to fulfill the condition. Apply for charity 85%. You know, a normal charitable trust has to take lot of tension. What lot of tension? 15% will become exempt. But for 85% you have to apply on charity. You have to take the registration also. There is a hell lot of formality for a normal trust. But one special privilege for hospitals and educational institution. You know what privilege they have? Their income is directly exempt. Without the condition of they getting registered and apply for charity 85%, nothing like that applies. Provided it is solely for hospital or education purpose. It should not have mixed object. First, what is H and E? H for hospital, E for education institution. So see, you should be solely doing hospital, solely education, or hospital plus education, no other thing. If you do some other thing along with hospital education, then you are not solely into hospital education. Then you will not get the privilege of 1023C. You know what is the privilege in 1023C? Look, fully exempt without conditions. You know, for a trust, conditions is a big torture. One of the condition is go for registration. Registration can get cancelled also. Then 15% is easily exempt. 85% you have to apply. Don't apply for ATS. So much of headache is there. But all this headache is not there under section 1023C. Provided these conditions which I am explaining should be satisfied. So what is condition 1? You should be hospital or education institution. And you should be solely into that. No other thing you have to do parallelly. Then you should be NPO. NPO means not profit making organization. You should be financed by government. Here comes the main reason. There are many hospitals in our country. They are run by government. They are financed by government. So that's why they are enjoying a special privilege. What is a special privilege? No condition applies to them. Their income is directly exempt. See, when something becomes exempt under 10, it is a straightforward exemption. What about other trust? This other trust will get exemption under 11 and 12 after fulfilling so many conditions and taking so much of tension. But this he people get easy exemption. Logic, they are financed by government. Plus, they are also doing the most important thing for our country, hospital, education institution. They are not small thing, na? Can be financed by government means what? Either wholly financed or substantially. Is either this hospital and education is fully running with government fund, or substantially. Substantially means out of your total receipts, more than 50% comes from government grant. If out of the total receipts of hospital, education institution, more than 50% comes from government grant, that means government is sponsoring you more than 50%. So it is called substantially financed. Wholly means you are fully funded by government's money. Substantially means out of your total receipt, more than 50% comes from government through government grant. Then only you will get exemption under 1023C. Then, if you are not funded by government, means you are a private hospital, then your receipts should not be more than 5 crores. Means you should be a small hospital. See, basically, somewhere there is a soft corner for hospitals, education institution, because they are doing the best thing in the country. Do you agree they are doing the best thing? So government has got a full soft corner and government is ready to exempt them. But for private hospitals, only if you are a small hospital. Small means your annual receipt should not be more than 5 crores. It should be less than equal to 5 crores. Then you are easily exempt. That means if there is a private hospital whose receipts is 100 crores, then they will not enjoy 1023C. Then they will be subject to normal provisions of 11 and 12. 11 and 12 exemption is torturous. It has got several conditions. You know the conditions. Initially there was condition of para. You have to be registered, apply at least 85%. After fulfilling so many conditions, you get exemption. Means it is not easy exemption, na? But when, if you are a big hospital, so see, it's like this. Look, government hospital, private hospital. Government hospital, even if you are biggest, always exempt. If you are private, if you are small, exempt. If you are big, exempt, but not easily, with conditions. See, eventually all the hospitals enjoy exemption. But if you want 1023C, it's a blessing. What is a blessing? Because your exemption will be without attachment of any conditions and formalities. Straightforward exemption. See, actually, this thing, you know why I have done? Just to complete the chart. Actually, in the Bare Act, if you see 1023C, it only talks about this much. It is just when we make a chart, if one thing comes this side, something should come on other side. Na? So in other side, what I have written? All other people who are doing charity or religion, all other means who do not fit in HE. For them, exemption is under section 11 and 12, subject to fulfillment of condition which I have already explained. See here what I have written. Income exempt only if conditions are satisfied. And exempt under section not 1023C. Huh? This chart looks defective, although I have shown 1023C into two parts. Technically, these people will get exemption under section 11 and 12. 1023C is meant only for HE people, HE. Here one thing I have written. What do you mean by substantially financed by government? Read. Government grant is more than 50% of your total receipts. And see, HE full form I have written here. Look, read. Hospital, medical institution, university, education institution. Like we have Mumbai University, we have got ICAI, Institute of Chartered Accountants of India. They are education institutions. Their income will become easily exempt. And they should be not profit making organization. Our ICAI and many of the schools in India, they are not profit making organizations. Okay. Although you feel ICAI takes lot of money nowadays, but actually they are treated as NPOs, non-profit making organization, and they are education institution. And if their annual receipt does not exceed, anyways, ICAI gets funds from government also. Anyways, we have to check two things. Either government should be funding. If government is not funding, then if you are totally private type, then your receipt should not be more than equal to, sorry, it should not be more than 5 CR. Then 1023C will give you easy exemption of without conditions. So wait, in one question which I did today, you should have a doubt. Look, you know, today I did one question number 1. See that question 1. In question number 1, read what was given. Tulsi Foundation of Public Charitable Trust runs a hospital. So here it was a hospital. But you know, because it was given registered under section 12AB, registration requirement under 12AB is not for HE people. See here, only for other trust there are conditions of registration. They have to be registered under 12AB. So in the question, what was the sign, you know? Since they are saying, what they are saying? The trust is registered under 12AB. That means they are not falling here. If they would have fallen here, they don't require registration under 12AB. 12AB registration required for other people. But then you will have a doubt. But sir, they have written hospital now. They have written hospital. So see, here we assume that along with hospital, they might be doing some other activities also. And to claim 1023C, you should be solely doing hospital. Solely. But it seems this hospital in question number 1 might not be solely doing hospital. If they would have solely been doing hospital, then they would not have required registration under 12AB. See, this registration requirement of 12AB, do you remember section 4 registration is what? 12AB. Requirement of registration under 12AB is there for other type of trust. But a student will ask, but sir, they have written hospital, so it falls here. No, when they have said that they have registered, so we are definitely sure that it is other trust. Maybe the question is not giving full information. They are saying it runs a hospital. But maybe this charitable trust might be having some other objectives also. Those who are full-fledged hospitals only, solely hospital, they only can enjoy 1023C. See this condition of solely. And see, some student asked me also, sir, here the gross receipts are also not crossing 5 crores. See, the gross receipts was hardly below crore, not even 5 crores. All that is okay. Hospital is also given and their collection is also not crossing 5 crores. Everything is okay. What was the main problem? They have said registered under 12AB. That means it is a normal trust which is doing hospital also, something else also, something else also. They are not solely hospital. Okay. See, solely hospital, their name is also like XYZ hospital. Here their name is what? Tulsi Foundation. It's a charitable trust, maybe having multiple objects. And for multiple objects, this thing is not applicable. Because here what they are saying? Multiple or solely? Solely hospital. Okay. See, why did I clarify? Because you know, right now you didn't ask me the doubt. After some time, you will ask me the doubt, sir, here this was a question on hospital, na? So we should have directly written a note in the question. Income is fully exempt under 1023C. See, if this kind of thing comes in question, 1023C, you don't even have to solve the question. Just write a note, because they are HE, solely for HE, funded by government, or the receipts are not more than 5 CR, income is exempt. Just one note you have to write. See, computation hassles you have to take when you fall under this criteria. And in exam, they will always keep you in this zone, so that you have to solve this sum. Na? See, here there is no solving of sum. Once you come to know this situation, you just have to write a note. Their income is completely exempt, without bothering to see how much they have applied, how much they have accumulated, Form 10, Form 9A, nothing. Direct exemption. But don't worry, generally the question which we solve, it will always be of this category, where you will go as per 11 and 12, that computation format you will follow, okay? But I had to give this explanation because in every batch students ask me the doubt, sir, this was hospital, why didn't you straightforward take exemption under 1023C? My answer is, because the wordings are registered under 12AB. And who takes registered under 12AB? Those who are having multiple objects. If they would have been solely hospital, they would not have taken registered under 12AB, na? So anyways, topic of charitable trust is over, except two questions which are left, which you will try first, then I will discuss. Which two questions? Question number 2 and question number 3. Both the questions are very good sum, especially question 3 is best. It is covering many points, it's a master problem, okay? So these two questions you solve, answer I will discuss in the next lecture. Revise and come, please revise and come.